Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you this morning, and as always, we're taking your email questions, so send those to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. We have all kinds of great information, free reports, things like risks you need to avoid in your retirement portfolio, to why annuities are dangerous to your wealth in retirement, and so on. So go to ReznyWealth.com, scroll through our website. You can also sign up for instant email alerts on investing topics I'll be talking about. And it also lists all my radio shows and my schedule for my TV shows in addition. You know, one of the things I want to talk about in today's program is really investments to avoid. I've been managing money for well over 30 years. One of the biggest mistakes that I find is investors are often sold investments through Wall Street style firms, brokers, so-called advisors, annuity people, banks. These firms are not fee-only fiduciary money managers. So any Wall Street style firm or bank, insurance company, these firms manufacture product or sponsor product or have selling agreements to sell products. Their whole really game is selling you investments that often make those firms more money than you. So I'm going to talk about some of the really poor investments you never want to touch in your portfolio. These are the most suspect overall. And these are the ones I often see show up in portfolios on a regular basis. And these are also the ones I get the most calls on for my TV and my radio shows. The worst overall investments you can ever invest in are annuities. Annuities are brutally expensive. They have lockups and surrenders. They're basically garbage. I know a lot of you out there, probably half of my listeners, have been sold 1 to 4 annuities. Statistically, that's what we see when you come into our office to talk to us about managing your wealth. Annuities are garbage, plain and simple. They have high internal cost structure. They have high surrender fees to get all your money out. They have lockup periods often that can last 10, 12, 14 years to get your money out. They're garbage. There's 2 main styles of annuities, though. There's variable annuities that invest in different types of securities, and then there's equity index annuities that really are more like a fixed annuity with kind of a hybrid feature. But rest assured, both annuities are garbage. They're sold by salespeople, and those salespeople might call themselves advisors or a wealth manager. They're not managing any wealth at all. They're simply selling you an annuity. Once you buy an annuity, you're locked in for a long period of time, and most of you investors, it's going to take about 3 to 4 years till you realize, wow, this thing is really performing lousy. How do I get out? I can't, because I still have another 8 or 10 year surrender penalty. So again, never buy an annuity. If you've bought one and you've got a sizable amount, maybe you need to get yourself a second opinion. But annuities in general are garbage, and they're sold to unsuspecting investors who don't read the fine print. Let's talk about non-traded REITs or real estate investment trusts. Wall Street firms love selling this stuff to their clients. They pay huge commissions to the advisor, salesperson, and they have lockup periods that can last 10, 20, 30 years. They're not liquid, so you really can't get out. By the way, you could buy a real estate investment trust that is traded that you can buy today and get out tomorrow. And there's many of them out there. But why do Wall Street firms or these brokers sell non-traded REITs? Because they pay huge, lavish commissions. The expense ratio of these non-traded REITs are also sky high. So again, robs your return, robs your liquidity, and really these things are developed and meant really for these Wall Street brokers and the firms really to line their pockets, in our opinion, more than yours. Stay away. The other, alternative investments. Sometimes these are called hedge funds or commodity funds. You might have some of these in your portfolio already. A lot of the Wall Street firms and banks love these because, again, they have lockup periods, surrender penalties, high cost structure against your money, and it pays lavish commissions to, again, the advisor, salesperson. So again, when they're selling you these products, they are not fee-only fiduciary money managers, as I've talked many times before. Stay away from hedge funds. Stay away from commodity funds. Again, they're garbage. Anything that has insane expenses and lockups never belong in your portfolio. Another one are structured products. Structured products, again, are sold through Wall Street and brokers, advisors, salespeople. These things are manufactured by these Wall Street firms. They're again sold and they're promised all kinds of grandiose opportunities and or risk reduction strategies. And all it really does is reduce your return, high expenses take away from your net return, and also insanely locks your money up when things don't go the right way, you can't get out, or at a significant cost to get out. Stay away from structured products. Options. Options are another lousy investment. Options are complicated. They take lots of time if you're going to trade options, but your broker, advisor, salesperson, whatever you want to call them, loves options. You know why they like options? Because they constantly mature every month or every 6 months or somewhere in the middle, and you're constantly buying new ones for big commissions and fees. Again, options for 99% of you who don't have 6 or 8 hours to spend a day watching the markets and trading options, you probably shouldn't do them. And don't think your broker or advisor is watching these any more than you are, because again, you're buying these on commission. This is not a managed asset. These are things that you are ultimately responsible for. They're risky. You're going to lose a lot of money. In fact, I will tell you something. I've had numerous people over 30 years managing money call our firm, want to interview us about managing their wealth. Many of them bought options, lost a fortune, if not half their net worth. I've seen some real destruction with options, so don't think they're safe. You could lose a lot of money real quick with options. If you want to learn more about investment mistakes to avoid, I've got an upcoming webinar, The Disturbing Facts Most Investors Are Shocked to Learn. How you, the investor, gets ripped off by banks, Wall Street firms, and annuity salespeople every day. If you want to learn how to protect your wealth from bad advice and sales, go to ReznyWealth.com, click on the webinar tab. We have a webinar next week. We have limited seating, so sign up right away. It'll talk about my full topics to be discussed. You can sign up instantly. And again, the only way to sign up for our webinar is through our website at ReznyWealth.com. And you will be glad you did. You're going to learn a lot. And as I've always tried to educate, learn from others' mistakes. It's a lot cheaper, folks. Attend our webinar. You'll learn a ton. And in our opinion, it'll help you move ahead in a more prosperous manner. I'm going to go to my first question. Amanda in Toledo, Ohio. What is an appropriate amount of cash holdings? Amanda, great question. It really depends on your situation. What I normally tell investors is this. If you leave too much money in cash for long periods of time, it's going to have a detrimental impact on your portfolio return. So this is what I would say. $10,000, $20,000. Don't go with 6 months living expense or a year like a lot of the Wall Street firms tell you to do. You don't need to do that. $10,000, $20,000 in cash reserves. These are just emergency reserves you may need quickly. If you have a major purchase coming up in the next, let's say, 6 months or 2 years or somewhere in the middle, let's say you need $50,000 for that down payment on that new house, keep that in cash and keep that safe. So anything you don't need for at least 2 years or more, get that money invested, again, based upon your risk profile. Leave $10,000 to $20,000 in cash. The other thing you could do is open a home equity line of credit against your house and utilize that as an emergency reserve if an emergency comes up. But I will tell you, the majority of you are never going to have an emergency where you need magically $20,000 or $30,000 tomorrow. You can often wait a day or two, get money out of your investment account without having it hinder long-term, ultimately, the returns on your portfolio. Bob in Naples, Florida. I see the marijuana industry eventually exploding. Do you think this is a solid investment or a speculative investment? Bob, I would not touch marijuana stocks with a 10-foot pole. This is a fad. It's not different this time, as I often have heard from investors. Oh, marijuana stocks are going to make a fortune. No, they are not. These things are thinly traded. They're high risk. They've been around for a while. They IPO'd initial public offering. A lot of them kind of ran up and then crashed back down. I would not touch these stocks. They're going to make minimal profits. It's not going to be the savior of the investment market. It's just going to be another fad, and investors too often chase fads and they get burned. This is speculation at its best, and it's going to be speculation against your retirement and financial security. Folks, I'm going to take a quick break. Go to ReznyWealth.com, check out our website, download any of our groundbreaking reports. You can sign up for instant email alerts, and make sure you check out that webinar tab. The disturbing facts most investors are shocked to learn. The true cause of poor investment returns and how to fix it is right there at our website at ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. And I'm back. I hope you're enjoying today's show. We are taking your questions. Send those to Brian Rezny at ReznyWealth.com. I'll get to as many questions as I can during the show. And when you do go to ReznyWealth.com, our website, you can check out our TV show schedule. And I also do a live 2-hour radio show on Sunday mornings throughout Southwest Florida. Richard in Fort Myers, Florida. What are your thoughts on making use of option trading as part of an investment strategy? Richard, don't do it. I talked about options as a bad investment for most of you investors. Options are extremely complex. They are extremely time-consuming. If you are not skilled in options trading, do not do it. Brokers and brokerage firms love you to do this because you're constantly churning the money, meaning making them commissions. They are risky, they're expensive, and ultimately, the majority of investments that Wall Street firms manufacture to try to sell you, the unsuspecting investor, are really not quality investments. As I've talked for years, avoid investments that have a lot of speculation. Speculation does not pay off long term. You might get a quick hit, but at the end of the day, you'll probably lose most of it the next day. Speculation does not work, and I don't like options for most of you investors. You simply don't have the time, qualifications, schooling in order to do them properly. Hey, we do have an upcoming webinar, The Disturbing Facts Most Investors Are Shocked to Learn. How investors get ripped off every day by banks, Wall Street firms, and annuity salespeople. I'm going to teach you at this free webinar, you'll learn how to protect your wealth from bad advice. Too many of you have been harmed by being sold crummy products through that Wall Street firm. Maybe you bought the annuity at the free steak dinner seminar. We want to teach you the things you want to avoid. At this webinar, and again, to sign up, go to ReznyWealth.com. We're going to teach you the pitfalls, areas to avoid. We want to teach you how not to be emotional with your money. We're going to talk about the big conflicts that plague too many of you retirees and why your retirement, in our opinion, is half what it should be from the lousy bad advice you've had in the past. If you continue on that track, it'll continue to be lousy in our opinion. Go to ReznyWealth.com and make sure you sign up for our upcoming webinar. Larry in Palm Coast, Florida. Brian, how much upside do you think is left in the market? Larry, on the short term, this is what I'm going to say. In the next month, 3 months, 6 months, you're going to have normal volatility. We could have a 10% pullback before we go up another 10%. Nobody really knows what's going to happen in the short term. But it's not the upside of the market. It's the long-term growth of the economy you're invested in. So let's say you've done your research, which every day you should be doing research, and you research the U.S. economy, which we actually like. Over the next 3 to 5 years, I think investors who are invested properly in the equity markets and the U.S. economy have a chance to do quite well. So there's going to be short-term volatility every year. That's normal. But over the next 3 to 5 years, I think there's going to be some great profits to be made. And I think the equity markets in the U.S. are going to continue to be one of the best places you can invest. And as I've made a comment multiple times over the years, stay away from Europe. It's a cesspool of socialism and really higher risk than the U.S. with substantially less opportunity on the upside. I hope that answers your question. Dean in Naples, Florida. Our portfolio is $850,000 in stocks and mutual funds. My question is, we seem to have about as much volatility as the market, but our returns are always way less, like 3% less, based upon the S&P, from what I can tell. Our advisor said that is normal for a dividend portfolio. Your opinion? Hey, that's a great question. Number one, that is not normal. If you are invested in basically all equities, you should be making similar returns if the S&P 500 is your benchmark index. Similar returns. You should not be making 3% yearly less. That means something's wrong. And you made a comment about dividend stocks. One of the things that I often find investors do is they will chase certain sectors of the market. If you're going to invest in the U.S., look at the whole U.S. market and then pick the best opportunities within the U.S. market. Don't just focus on dividend-paying stocks, because if you do that, you're going to leave out 95% of other stocks that pay little dividend or no dividend, and those could be your best opportunity. What you want to be concerned is, as an investor, is what's called total return. The growth of the value of your asset plus that dividend gives you a total return. So what I'm guessing is you probably need to find yourself a new money manager. Your advisor sounds to me like you really are working with a Wall Street style firm, and really that's a salesperson, not a fee-only fiduciary money manager. So only work with a fee-only fiduciary money manager if you really want money management and you want a firm that legally works for you 100% of the time. Go to ReznyWealth.com. You can download our groundbreaking report. It talks about fiduciary, money management, and the conflicts you need to avoid in your portfolio. Ken in Fort Myers, Florida. We have 2 Lincoln Choice Plus variable annuities. I really don't understand the expenses, and the annuities have performed poorly the last 5 years. Our investment, $250K, is now worth $257. We have procrastinated coming to see you for a second opinion. Help. Can you get us out? Great question. So listen, first off, this is what you have. And I'm going to talk about annuities in general, okay? So variable annuities in general have high expenses. They could have annual expenses that run 3.5%, 4.5%, 5.5% a year. So the reason your returns have probably been lousy is because your expenses are so high. Annuities in general, and I always stress this to every one of our listeners, your annuity is no different, folks. If you own an annuity, they all have high expenses. That's what the annuity is all about. It's all about making money off of your money and giving it to the insurance company. High expenses take away from your return. So think about this. If you're invested in the equity type market investments in that variable annuity, and the market goes up 8%, okay, and your expenses are 4.5% yearly on that annuity, how much did you make? 3.5%? 2.5%? You didn't make a lot. You took all the risk of the investment, but because your expenses were so high, you made a lot less. That's why we hate annuities. High expenses, higher risk, robs your returns. There's no reason to buy an annuity unless you're trying to make your annuity advisor, salesperson, a bigger wealth in their pocket than yours. Hey, by the way, if you want to learn why annuities are bad for your wealth, or other investments you should avoid, or why investors like you get ripped off every day by Wall Street, banks, and annuity salespeople, I've got a free webinar, The Disturbing Facts Most Investors Are Shocked to Learn. The true cause of poor investment returns and how to fix it. If you'd like to attend my upcoming webinar next week, go to ReznyWealth.com. Click on the webinar tab at our website. You can sign up there. It will also be talking about and cover the additional information that I will discuss at this webinar. And one of the things I will stress about our webinars, these are game changers. These will change how you look at investing, how you protect your money, how you avoid the conflicts that we feel have ultimately hurt so many of you investors. And again, I'm going to go back to this. About 10% of firms nationally, from our estimation, are fee-only fiduciary money management firms. Those kind of firms would actually work for you legally 100% of the time. Wall Street, banks, annuity salespeople, these firms are not fee-only fiduciary money managers. Not at all. Conflicts, higher cost, bad advice. Judge for yourself. Go to ReznyWealth.com. Download our groundbreaking report. Again, the biggest risk you have is fiduciary versus the rest. You can download it for free at our website at ReznyWealth.com. Kim in Clearwater, Florida. What do you think about Apple? Hey, I think Apple's a great company. The stock is getting a little bit pricey, but I like the company overall. We do have positions in Apple. Our positions can change at any time. But what I will say is this. Like any stock, make sure you're doing your research. At our firm, we're doing research every single day on all of our investments within our client portfolios. That's important. You can't just buy something without research. You can't do research and buy it and then forget the research in the future. When you buy something like Apple, you need to have a sell strategy, and always never own more than 5% of any one individual stock in your portfolio. You're taking way too much risk if you do. Dale in Bonita Springs, Florida. What do you think of preferred stocks for dividend income? I think it's an opportunity. So again, I'm going to go back to this. If you're looking at preferreds, don't overload the boat. I'd say between 5 and 8% allocation to preferreds. But remember this. Preferred stocks act very much like long-term bonds. So if interest rates go up over time, preferreds often will lag and go down in value. So you kind of remember that. It's not the savior. Don't overload the boat in preferreds. Like I said, 4, 5, 8% allocation depending on your risk profile, goals, and objectives. But do research. Not all preferreds are the same. Some are less risky, some are more risky, so make sure you do the right thing with your money. Folks, I'm going to take a quick break. Before I do, go to ReznyWealth.com. Check out our website. Check out our upcoming webinar. Click on that tab. Go through our website. We've got some great free reports you can download instantly. You can also sign up for instant email alerts at ReznyWealth.com. I'm going to take a quick break. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. And we're back. I hope you're enjoying today's program. Again, send your email questions to Brian Rezny at ReznyWealth.com. We'll get to as many of those as possible. And as always, visit our website, ReznyWealth.com. Fred in Naples, Florida. My wife and I, both 67, recently retired. Our advisor wants us to put $700K into an equity index annuity for lifetime income. How can a retired protect themselves from inflation? Will this help? Fred, no. Do not do it. Your advisor is a salesperson of annuities, and they're not legally working in your best interest. First off, an annuity does not protect against inflation, especially one of these equity index annuities. If you buy an equity index annuity, plan on high expenses that are going to take away from your return. Plan on maybe making 1 to 1.5% annualized return over a 10-year time frame. You're going to make super low returns. That's not going to even keep up with inflation. It runs around 2% plus. Once you lock yourself into this annuity, it's almost impossible to get out without a huge surrender penalty to get all your money out. The average investor that is sold one of these annuities, and I use the word sold, it takes them about 3 to 4 years till they realize they made the biggest financial mistake in your life. So Fred, if you do not want to ruin your retirement, do not buy an equity index annuity. They're garbage. They're going to have low returns. If you want to be conservative, go to the bank, buy a CD. It's going to have a similar return as an equity index annuity. This person is trying to sell you the bag of goods, and if you bite, you are making the biggest financial blunder mistake in your life. Byron in Fort Myers Beach, Florida. Oil and energy stocks have not had a lot of growth in general. I sold some of my large oil names years ago, but I still keep 2 energy ETFs, IXC and VDE, thinking their time will come to return. Would you continue to hold these for the future? This is what I would say is this. We currently own positions in the oil market. These are trades for us. We haven't owned oil for a long time, but we just added a recent allocation to the oil sector. So what I'm going to say is this. Ultimately, oil prices are going to stay low. Companies that produce oil are not going to have the ability, when you have $60, $65 oil prices, to make the profits they did, a decade or 2 decades ago. We're energy independent. We're moving away from fossil fuels slowly over time. Energy prices will stay low. So what I will say is this: if you own energy, this is going to be a short-term trade. It might last another 30 days. It might last to the end of the year. Who knows? You got to watch the charts and valuations, how fast it recoups. But this is a reinflation trade, we call it, not a long-term hold at all. Hey, we do have an upcoming webinar, by the way, The Disturbing Facts Most Investors Are Shocked to Learn. How investors, you, get ripped off by Wall Street, banks, and annuity salespeople every day. If you want to learn how to protect your wealth from bad advice, if you don't want to be sold the next crummy investment, if you're at all questioning the advice you're getting, if you want to learn a boatload of great information in a short period of time, go to ReznyWealth.com. That's ReznyWealth.com. Click on the webinar tab. There's all kinds of great information there. You can it'll talk about what I'm going to be discussing. It'll talk about the time frame and the sign up at ReznyWealth.com. One of the biggest things I stress all the time to investors, I've been managing money over 30 years. 30 years has taught me a lot. One of the biggest things that I teach you, the investor, is simple. Learn from others' mistakes. People make mistakes all the time. If you can learn from their mistakes, you'll avoid those costly mistakes. I've seen a lot of carnage in portfolios. I see you, the investor, who hires, maybe it's your brother-in-law, Bob. He's a great guy, but he works for a firm, maybe one of these big Wall Street firms or a bank. These firms are not the only fiduciary money managers. Now, your brother Bob's a great guy, but the stuff in your portfolio he's selling you is simple. It's the stuff that he's required to sell. He has to sell in order to make his pay grade. These are products that that firm manufactures and or sponsors or has a sales agreement to sell. That's the problem. So Bob is not the problem. It's the firm or the umbrella Bob works under. Remember, the only kind of firm you should ever entrust your wealth to is a fee-only fiduciary money management firm. Any firm that is not fee-only does not legally work in your best interest 100% of the time, and they're really a sales organization, and they're probably not managing any money at all. They're selling it off to other people. You have to protect your wealth. You have to protect yourself from ultimately bad advice. One of the things that is interesting as we round into this new year is the emotions that often drive investment decisions. You, the investor, have to make sure that you don't make those emotional decisions. You need to stay true to your plan, and if you need help, call Rezny Wealth Management. If you're tired of conflicts, bad advice, let us show you the difference we provide our clients every day. Honesty, integrity, compassion, and competence. That's the Rezny Wealth difference. We do work with larger investors who have $1 million and greater. If you'd like to talk to us about managing your wealth, call our office during the week at 800-618-8577. Again, if you're at all questioning the advice you're getting, if you've had lousy or mediocre returns, it's time you call Rezny Wealth Management for real advice, real money management, 100% of the time. Over 30 years of experience. Again, call ReznyWealth.com. Make sure you visit our website. And as always, make sure you have yourself a safe and profitable week.